Saylor talks about using AI to come up with those preferred equity, but it's technically equity, but practically it's debt. So it's a tokenized bond. If they want to have pension funds and other funds buying their preferred stock, then they want a credit rating on those preferred stock, and the credit rating is better if there's not any debt above them.
If we now approach this topic of preferred shares from an investor's perspective, where would you say are they beneficial to the investor?
I think with those yields, you are looking at pension funds like the fixed income market. I think the credit ratings will open the doors to get those preferreds really to the broader financial market. And the thing I like is you're retrieving capital from these traditional markets and the central bank. You're getting money out of the euro and putting them basically through strategy into Bitcoin.
What is the preferred for you, and why is that?
I would, in a risk-on environment,
Johan Bergman, a former bank employee specializing in commercial real estate mortgages, has been an entrepreneur since 2019. He spent 3 years focused on Bitcoin self-custody and client relations.
Today, he works as an analyst and writes a bi-weekly letter for the Bitcoin layer.
Nobody's gonna buy your debt or your instruments if you don't have a strong operating business or a strong balance sheet. So Saylor talked about 30%. They're now at 15% debt, and that's including the preferred. If you're living on a fiat standard, you need a strategic Bitcoin reserve to bail you out in the future, maybe. It's your insurance. But if you're on a Bitcoin standard...
Hey guys, welcome back to Less Noise, More Signal. Today, I'm very pleased to be joined by John Bergman. Hey John, thanks to have you on the pod.
Hey Pascal, thanks for having me. I'm a listener regularly to your podcast, so I'm honored to be on this side of the
Yes, that's amazing. That's usually how it works. Like you have people listening in, and then we met, I think it was in Prague for the first time. Exactly. Ever since I've been reading your stuff, because you put out some amazing articles, mostly around the topic of Bitcoin Treasury Companies. At least that's what I've been reading. And I just felt like, okay, this is amazing, because I wanted to get somebody to talk about these things, because I was in Riga as well a couple of weeks ago. And there, obviously, I talked to Preston Pish, and he's very well known for talking about these topics as well. But I think he's just, totally booked out, and I haven't been able to get him. And then I was looking for a valuable and adequate substitute, so to say, and that's where you came about. So it's just amazing to have you on the show. If you could quickly introduce yourself, who you are, and then also why are you proficient enough to talk about this topic, that would be great.
Yeah, so I worked at a Dutch bank for 5 years, 2012 to 2017, 18. I was on the desk for mortgage lending for commercial real estate. I found out Bitcoin in 2014 or something, but it didn't click. So the technical aspect really clicked, but not the monetary aspect. It sounds weird, but in 2018 with Seyfedien's book, with all the other podcasts and more podcasts, more books, then it really clicked. All right, it's not about the blockchain, it's about Bitcoin, it's about the monetary protocol. And so after that, I became an entrepreneur. And I also spent 3 or 4 years in self-custody, multi-sig, metal plates, seed hammers, all the stuff. And since this year, I'm starting to write about Bitcoin. I'm writing for the Bitcoin layer, and I'm starting my own Substack. I'm also I'm a co-founder of a proprietary trading firm, small, but trying to really use that knowledge that we've gathered to make actionable investments. So and for the Bitcoin layer, I'm writing mostly about Bitcoin Treasury Companies. I'm writing about on-chain metrics and option market.
What if you could lower your tax bill and stack Bitcoin at the same time? Well, by mining Bitcoin with Blockware, you can. New tax guidelines from the Big Beautiful Bill allow American miners to write off 100% of the cost of their mining hardware in a single tax year. That's right, a 100% write-off. If you have $100,000 in capital gains or income, you can purchase $100,000 worth of miners and offset it entirely. Blockware's mining as a service solution enables you to start mining Bitcoin right now without lifting a finger. Blockware handles everything from securing the miners to sourcing low-cost power to configuring the mining pool. They do it all. You get to stack Bitcoin at a discount every single day, while also saving big time when tax season hits. Get started today by going to mining.blockwaresolutions.com/LNMS. Again, that's mining.blockwaresolutions.com/LNMS. Hey guys, I just wanted to let you know I published a new book, The Bitcoin Enlightenment, co-written with my buddy Daniel and none other than Mexican billionaire Ricardo Salinas. It's a deep dive into the monetary system and its future. In it, we make the type of connections that go beyond what you'll hear from your average Bitcoiner, MMT advocate, or macro pundit. So grab your copy on Amazon today. You'll find the link in the show notes. And now on to today's show. Okay, I see. Very interesting. Yeah, I definitely also want to learn more about the proprietary trading firm that you just started. That's something that's near to my heart as well, ever since I started working for a bank that I'm currently with part-time as well. So definitely some overlap there as well. But I'd like to start with the micro strategy topic, or just the Bitcoin Treasury topic in general. And I feel like I told you already before we started recording that there are a lot of people like me who have followed this just on the sidelines. They heard about Saylor buying Bitcoin in 2020, and then heard about him actually doing some tricks on Wall Street to buy even more Bitcoin with convertible notes and then preferred shares. They heard about all these big numbers. They saw Saylor picking up a lot of Bitcoin from the open markets. But I feel like many people haven't been able to follow this entire trajectory, and that there's sort of if you have studied Saylor's work like you have, that there is some nuance to this, and it all makes sense, the journey that he's gone through. If you could sort of sum this up for us and bring us up to speed, that would be great.
Yeah, sure. So, please help me with getting on those topics. But so yeah, Saylor basically told the audience in 2020 and his shareholders that after the COVID stimulus, he really realized that his cash position, his cash reserve, was a melting ice block, and he told everyone that he went out to look for the best investment, and he came onto Bitcoin. I think Strategy and Michael Saylor, they went through a journey. I think at that time they didn't know what they would do in 5 years. So basically they started just buying Bitcoin with their cash reserves, and their journey, they thought, yeah, we can also lend money to buy more Bitcoin. And they started out with those convertible debt. They had also some high yield notes. They had secured. They had also Bitcoin collateralized loans with Silvergate. I think a lot of people still, or everyone who was around in 2022 knows about strategy or MicroStrategy at that time. And that's also where the FUD, or it wasn't really FUD, because it was reality that they had some liquidation price on their Bitcoin, that if Bitcoin went below a certain price, then Silvergate Bank, because they had the collateral or the Bitcoin as collateral for the loan. And I think a Strategy and Michael Saylor learned from that. I wouldn't say it was a mistake, but they learned from that choice, the choice to lend money with Bitcoin as collateral. And then I think they went back with the convertible debt issuance when they figured out that, like, the volatility is vitality story narrative. And after that, I think they make this journey, and they are going now for debt that has an expiration date. So no maturity, no term debt. So, and Saylor talks about using AI to come up with those preferred equity, but it's technically equity, but practically it's debt. So it's a tokenized bond. So you have this par value that if the company goes bankrupt, the shareholders will get this par value if there's enough assets still left. So that's why there's and then you have this dividend on it that they need to pay out. So I think that's the journey, and they figured out during the way what they think is best to accumulate as much as Bitcoin as possible.
Yes, I see. Yeah, I mean, and now it also dawns on me why Saylor. I listened to a podcast a couple of months ago between him and Saifedean, and he was really vigorously arguing against lending against or borrowing against Bitcoin. It was more from the borrowing side, because he was really mentioning Bitcoin. If you borrow against it, it's mark to market something, and then Bitcoin with its volatility can really get you stopped out. And I was sort of surprised because a lot of people from the retail side and the private investors are now looking at this because they're feeling like, okay, this is a way that I can sort of extract some of the value that's locked in Bitcoin without selling them. But now, remembering this, as you told me, with the Silvergate situation, I mean, he's gone through this, and as you said, it was probably some of the hatred that he received during the 2022 bear market for having had this loan with Silvergate. So that's interesting. I mean, you said about the convertible notes, that you mentioned. When I figured, and I did another interview back in the day with Richard Byworth, that went viral, and from there on, I really understood the concept of convertibles. It sounded like also quite genius to me. But now in hindsight, I think, and Saylor probably agrees, and you as well, it wasn't the best choice. And why wouldn't he want to continue with these convertible notes, even especially if he can raise them? And because of Bitcoin's volatility, there's this option embedded, which is worth a lot. And that's why he could sometimes get these convertible bonds issued at 0.0 interest. Why wouldn't he continue with this?
So this is such a great question, and I also listened to your episode with Richard Byworth. It was a great episode. I learned a lot from it too. And so I'm not a convertible expert. I think Richard knows his stuff better. But yeah, I think it's a great question, and I think because what, like you mentioned, the fact that they could offer such a low interest rate on that debt because of the optionality, because of the embedded option. And I think Saylor came to the realization that they really don't want a maturity date on their debt, because even though it's great, I still think it's a good product. And I think, but remind me that we go through that with the preferreds, because there could be a reason to not issue more convertible debt because they're more senior to the preferred equity, and that would mean that all the preferreds are less. Yeah, their credit rating will be lower because they're lower in the capital stack. But back to the convertible debt, like Richard told you in the episode, is that a lot of buyers of the convertible debt are hedge funds, and they're also selling stock. So basically, I don't know, they come up with this, they calculate their delta on those shares and on the convertible bond, and they're hedging themselves to be delta neutral. So basically, if they convert and they get 100 shares and the delta is 0.5, they're gonna short 50 shares of those 100 shares. So they're delta neutral, and they're basically scalping gamma. So they're getting some, they're harvesting volatility, they're getting some percentage gains. But in that way, the common stock has also a lot of shorting volume. So I think that's something that they want to prevent. I also heard Simon Gerovich from Metaplanet talk about this with Richard. And I think Simon also, because Metaplanet also announced that they were going to issue preferreds, and they are basically bypassing the whole step that strategy made with convertible debt. They're going straight to the preferreds. And I think because strategy also said that they want to get those preferreds off the balance sheet, because the convertible debt off their balance sheet, because then you want to strive at this fixed income crown jewel, and that needs to be at the top of the capital stack. But if you issue more convertible debt, it will be higher in the capital stack. So if they want to get credit rate, if they want to have pension funds and other funds buying their preferred stock, then they want a credit rating on those preferred stock, and the credit rating is better if there's not any debt above them.
Self-custody is one of Bitcoin's greatest strengths. And to truly benefit from it, you need a hardware wallet built with seriousness and world-class security. Enter Bitbox. Bitbox embodies privacy, precision, and uncompromising quality. It's incredibly user-friendly, yet powerful enough for advanced users. You can connect it to your own Bitcoin full node, fine-tune your own transactions with advanced coin control, and even add an optional passphrase for maximum protection. It's also fully open source, echoing Bitcoin's core principle, don't trust, verify. And while not all of us can verify every line of code, trust here is built on something real. I've known Bitbox's core contributors for years, and I've come to trust their expertise and integrity. So if you want to secure your Bitcoin like a pro, go to bitbox.swiss/LNMS, order your Bitbox now and get 5% off. Again, this is bitbox.swiss/LNMS. Okay, I see. Yeah, I want to get into this as well to talk about the credit trading and why it's so important to have for these products. But maybe before I want to approach this from a high level perspective, to talk about these preferred shares. This is probably something we've seen in the traditional world as well. It's not something that Saylor exclusively came up with. But then why is he now going for these preferred shares, and why does it seem to us and to others who are looking at this that this is somewhat the best of all worlds, that you can have? One thing you mentioned already is it doesn't have a maturity date, which is from Saylor's perspective quite nice, because then he knows there's not going to be this maturity wall where he has to kind of pay them back, and so he can actually roll them indefinitely, it seems. What are other advantages that these preferred shares now bring? And then maybe also talk about the capital stack again. Where do they sit exactly in the entire stack?
Yeah, so great question. So let's see the capital stack. You have 4 preferred series. So you have the Strive, it's the most senior. Then you've got Stretch, that's the most recent one. And then you get Strike, and then at the bottom you have Stride with a D. And all of those preferreds have their own terms and conditions, basically. So Strive is the most protected one, and that's why he called it a fixed, like the crown jewel, fixed income, highest in the capital stack. So the highest possibility that shareholders will get their money back. And the dividends are cumulative. And what does that mean? That if strategy were to miss a dividend payment, it's just getting added to the next dividend payment. And the Strive had this enhanced protection. I think shareholders can appoint a new board or like a side board that has the authority over the board of strategy, that they're gonna make sure that those dividends will get paid to the shareholders. So that's really a really good deal for the Strive shareholders. And then you get Stretch. No, first do Strike and Stride, because Stretch is the new one. Then Strike has that convertibility, that if the stock of strategy or MSTR trades 10 times higher than Strike, then you have a convertibility option so you can trade 10 shares of Strike into 1 share of MSTR. And you have Stride. So Strike also have cumulative dividend. So it's also basically, it's somehow protective. And Stride is basically the junk bond variant and doesn't have the dividends are non-cumulative. So if strategy were to miss a dividend payment on stride, it won't be added up to next time. It's just they missed it, and shareholders have to live with that. I don't think they are going to use that option. I think they're only using it as a parachute. Like if you're a pilot and you're in a plane and the plane is crashing down, you're gonna use a parachute, but you only can use it once, because after that, shareholders are really losing confidence in this kind of instrument, because they will ask themselves how many times will this happen in the future. So or strategy really need to get that confidence back, or it just is a lever anymore for them. So, and I think and you already mentioned it. I think that the maturity, it's dead without a maturity. I think that's basically the most important reason why.
Okay, yeah, so there's not that many other advantages from Saylor's perspective, would you say? Because, I mean, one thing that I heard him say, or others say, is that these preferred shares, they also help keep away the fiat-focused shorting strategies that were so common with MSTR stock. That's also, to me, if I hear this, somewhat of a advantage, that this has over the common stock. And then maybe again, this maybe against and the convertibles as well.
Yeah, and that's the topic where we talked about before, that there isn't. So they do have options. It came live last week on the preferred. So we're gonna see how that works out. Maybe if they start selling calls on those preferreds, but then it wouldn't hurt the MSTR. The only thing I heard some people were doing were selling covered calls on strike. But then normally you can write one call with 100 shares, then you have a covered call basically, and some were doing this with 1,000 shares of strike. But that would be the only possibility to dampen down the volatility of MSTR. Without the convertibles, you have less short selling, I guess.
Yes, I see. And if we now approach this topic of preferred shares from an investor's perspective, where would you say are they beneficial to the investor? For one thing, they, as far as I understand, have a dividend, a yield component built into them. And then also they might not be beholden that much to the volatility of Bitcoin itself. Or how would you talk about these in front of an actual investor who's looking at these? And then also my question is maybe hinting at the fact that I heard some people say that these preferred shares are somewhat of a fixed income alternative, and my ultimate question is, will the traditional world actually recognize this, or will it always be the Bitcoiners that will treat that as a fixed income alternative, which is not wrong? I mean, then it might be even not that crowded, which is nice. Or how do you think about this?
Yeah, all great questions. So let's start first. What does investors, or which investors are attracted to those instruments? And I think those are the investors that are looking for yield without too much volatility, like you mentioned. Because basically, if you are willing to go through Bitcoin's volatility, then you could have a better performance. Because if Bitcoin grows at a compounded annual growth rate of 40%, that's better than 10%. And then if you want to get some yield or if you want to have some income or free cash flow, then you can sell your Bitcoin over time. But because it's growing faster than the yield that is given by the preferred, it would be a better, you could better be buying Bitcoin. But a lot of people or institutions, they don't want to have that Bitcoin exposure, and there are all kind of reasons why they don't want it. So I think with those yields, you are looking at like pension funds, like the fixed income market, as you mentioned, and that's just, they want basically kind of a stable value and get yield from that And we already talked about the credit ratings. I think the credit ratings will open the doors to get those preferreds really to the broader financial market. Now it's still a Bitcoiners, but a lot of funds, a lot of pension funds, institutions they have a mandate and they are obligated to only buy a AA or AAA bonds or fixed income instruments. So, and those preferreds don't have credit ratings yet. So now it's still hard to get those preferreds all over the financial market. Basically, Bitcoin needs to go through this maturity phase where also the rating agencies like S&P or Moody's has to, at one point they need to come up with a credit rating. And that's why I think in the first earnings call this year, a strategy and Michael Saylor did a call to action to all shareholders. And they asked, all right, email your rating agency and ask them to rate those preferreds, because then that's a quicker way to really get that trading volume going. And this is also an important point that a lot of people are missing, because strategy still is using the common stock ATM to buy Bitcoin, and they're asking, why aren't you issuing more preferred to buy the Bitcoin with? But you need some trading volume. You need the traction. You need to be able to, if you want to raise hundreds of millions, what he did in the last couple of weeks, you really need to be able to put those issuance on the market. And if you issue too much, then the value of those preferreds will go down. And that's not something you want, because then you're diluting your preferred even faster. And if you're diluting your preferred even faster, then your liabilities, because it's better if you want to raise $1,000, and Strive is trading at $100, then you need to issue 10 shares of Strive to get $1,000. But if they're trading at $200, then you only need to issue 5 shares. And if you issue only 5 shares, then your future liabilities, your future dividend liabilities, are also half of them. So they have this balance that they want to issue the preferreds to buy Bitcoin with it, but if they do it too much, they will plummet the value of the preferreds, and they need to even issue more to get the same capital rate.
Yeah, it's really about threading the needle here, walking this fine balance of what to do. That's also what I learned about when I read your articles, and you carved it really, or carved it out really well, in terms of that there are many trade-offs involved here. I also want to come to this impossible trinity analogy that you mentioned, I think with the preferreds. Maybe just one last question before this is, you mentioned the credit ratings. You mentioned that Saylor has made this call to action to all shareholders that they should be pleading with the agencies. What's the realistic way? Can he also push for that himself? Get together with these credit agencies, or how do you get a credit rating? On your preferreds. That's basically my question.
So to be honest, I don't know. I don't know what's necessary. I think the agencies need to feel the pressure. They're not gonna rate something where there's little interest to the financial market. But if there's a lot of interest in those instruments, I think the rating agencies want to pick that up. So I think it's a matter of time, and it's a matter of traded volume and how much interest there is from the market into these instruments. And you ask about this stretch and this trilemma. So I heard Dylan Leclerc talk about this too. Like in this monetary, like governments have this trilemma in their monetary policy, that they have open capital markets, a stable exchange rate, and you have like monetary independence. But you have to choose 2. You can't have all 3. And I wrote about Denmark. Denmark has their own currency, but they wanted to have a stable exchange rate. So they pegged their Danish crown to the euro, but they lose their monetary independence. And the US has monetary independence and open capital markets, but they don't have a stable exchange rate. So they have a floating exchange rate. And strategy, I don't know if they knew, but with stretch, it's the inverse of strike, stride, and stride, because with strike, stride, and stride, the dividend payment is fixed. It's $10 or $8, and the value is floating. And with stretch, they try to peg the value at $100. But if you if you want to stabilize something at one end, the volatility needs to go out at another side. So, and that's the exchange rate. So if stretch is trading below, I think, 95 or 99, they have this guidance, this protocol that if stretch is trading below $100, they're gonna increase the interest rate to attract more investors. And if it's trading above $100, they could lower interest rate. But I think they're not going to do that very soon, because I think they just want a lot of demand for stretch, because that's their way to raise capital, and that's their way to buy Bitcoin. So before they're gonna lower interest rates, where the demand needs to be huge, because they want all that capital. And if you think about it, so this stretch is basically like a difficulty adjustment that Bitcoin has. And this is really cool to think about, because Satoshi Nakamoto, he wanted also a peg, because he wanted to be that the transactions that you can rely on, that your transaction will be
processed.
Yeah. Processed. Thank you. Yes, processed. So, and he thought, let's peg the block issuance with 10 minutes in time. But to do that, you need some controlling system. And he came up with the difficulty adjustment, that if blocks were found faster than 10 minutes, then the difficulty goes up. And if blocks are found in less or in more than 10 minutes, then the difficulty goes down. Maybe actually to stabilize the system and to keep it at 10 minutes, because then people can count on their transaction being processed if they pay enough fee every 10 minutes, but also this subsidy to the whole network, at a block subsidy, is like stretched over time. And I think this is brilliant. It's genius. It's very elegant. And I wouldn't say stretch is as elegant as the block or the difficulty adjustment, but it's also, I would say, smart. And it also shows that Michael Saylor is a real engineer, and he's a system engineer. Like Lane Alden talked about this. They're always thinking about a bigger system, and a bigger system could get unstable. And how can we stabilize this system? And basically, that's the rate adjustment on stretch.
Wow, yeah, very interesting. I mean, that's something I never heard. I definitely have to think about it in more details. But it really feels to me that, as you are explaining this, Saylor, as you said, is an engineer, and he has thought about these things like deeply, and there's a cost to everything, or also like a purpose. It's not just that he's issuing these products randomly, as some people sometimes say, it's just to keep the Ponzi going. Even though we don't know how this will turn out in the end, it could be, that everything fails, which is the same when Bitcoin started. We didn't know if it's ever going to work, and so, but it's still interesting that there is like more to the meat to the bone that a lot of people usually perceive. And to your point about the credit agencies, I think that's also where it comes back to the cyber hornets, where Michael Saylor probably will have them, or that's what he's betting on, that they will do the same with his preferred, just relentlessly talking about it as they did with Bitcoin itself. I want to ask one more question on the whole preferred or like the whole thing that he asked, the plethora of these products, it's obviously a little subjective, but if you have to choose, or you do, what is the preferred for you, and why is that? That would be nice to know.
Yeah.
Without giving financial advice.
Yeah, this is not financial advice. So, I'm building this this script that tells me to where is the best opportunity. But I think you have to compare them with like the benchmark. So I'm preparing Strive with investment grade yields, and I'm comparing Stride with high yield, corporate high yields, and then Stretch is basically your equivalent of your bank account. So I would, in a risk-on environment, I would buy Strike or Stride if Stride was like Stride is now trading at $80 or something, and it has an effective yield of 12%. And so I was calculating. So what would be the price of Stride if the effective yield was equal to the high yield, and that was $150. So because I think the US 10 is now at 4%, it's basically the risk-free rate. High yield corporate bonds was, I think, 6.5% or something like that, and Stride was trading at 12. So Stride could, if your yield could go down, it's like this inverse relation, like bonds. Yield goes down, the value of the bond goes up, so also the preferred. So, and I'm just looking, so where is the most gain to be made? But if you're in a risk-off environment and Stride is already trading high and corporate bond spreads blowing out, then the price should go down of Stride, basically, and then I would rotate into Stretch. So I would be into Stretch when in a risk-off period, and in a risk-on period, I would buy Stride or Strike, because Strike have this convertibility. So if strategy is ripping, so if MSTR is ripping, then Strike could be more valuable because it will trade as equity instead of a bond. And Strive for me would be like this this long term. Sometimes you have those barbell strategies, and I think Strive is, if you can buy Strive at a good price, then you lock in that yield. As I told, there's very enhanced methods to be sure that the shareholders are being paid their dividends. Also, I would use Strive, or one could use Strive as an arbitrage trade yourself. So let's think of your mortgage. So because you were talking about when we started the conversation about Bitcoin collateralized loans, yeah. So let's say you have some value in your home equity. So there's equity in your home because your house is worth 1 million and your loan is only $200,000. Then you could, if Strive is trading low, then you could get a loan if the bank wants to lend you it of $400,000. And let's say it's in Europe, the mortgage rates are 4 or 5%. Yeah.
Against your house, you would take out the loan.
Yeah. Against your house. So you take a second mortgage, or you just increase your mortgage, 400,000. But if you put it all in Bitcoin, you don't have that cash flow to pay the mortgage, to service the debt. So what you could do is, if your mortgage rate is 4 or 5%, and you can set that for 30 years out, and with that cash you can buy Strive currently with 8.5% yield, then you basically have a positive carry, a spread of 3.5%. So then you could, of those $400,000, you could buy with $300,000 you could buy Strive, or 250. Then you have enough dividend income to pay down the interest rate or service the debt, and then you still have $100,000 left to buy Bitcoin with it.
To buy Bitcoin, yeah.
Uncollateralized, and you never get in trouble with paying down your mortgage. Yeah, because the dividend payments are really protected. It's top in the capital stack. So I think, and this is what I really like about this whole subject, I also liked how Preston Pish puts it, because you're talking about the equity market, you're talking about bond market, you're talking about Bitcoin, you're talking about investment opportunities. So I love it. I love to think about it, and to write about it, and to talk about it with you. And I think and that's also a difference, if I think about it now, with the convertible debt. The convertible debt is more for institutions, and these preferreds are for also retail investors. So basically, every retail investor can do this arbitrage trade if they have the possibility. And it's basically also power to the people, and it's strategy that is making that possible.
Yeah. It's so fascinating. It's this amalgamation of all these different industries and topics. And that's, as Preston Pish puts it himself, that's why so many people don't get the hang of it, because they don't even understand one of these verticals, let alone all of them together. And that's also where it creates these asymmetric opportunity stands for people like us. Because I'm asking this question because obviously I hear a lot of Bitcoiners, who have been in Bitcoin for 5 to 10 years, who have a decent amount or stack of Bitcoin, that they're like, okay, I want to tap into the value of that Bitcoin. I don't want to sell it maybe for fiat altogether, but I want to maybe mobilize some of that value that's trapped in there, and that's why they come out with these borrowing against Bitcoin. Maybe this could also be for some Bitcoin holder to go into, to diversify into these products that you just mentioned, right? If you say, okay, I have this amount of Bitcoin, 10 to 20% I'll take off the table. I put into these products, which are not Bitcoin itself anymore, with all the trade-offs that they come with, but still they give me this other optionality of maybe having a dividend, an interest, something which is more fixed. Do you think this is a viable way to go for Bitcoiners as well?
Yeah, really good question. I'm struggling to see the opportunities still, because I didn't use their service yet, but I think Strike from Jack Mallers, I heard so much Strike, so it's Strike. I think the interest rate on a Bitcoin-backed loan is still 9 or 10%-ish. So I think you cannot do this arbitrage trade as effectively as you can do with a mortgage. And I want to point out, because as I said in the introduction, I became a Bitcoiner. I became a Bitcoin maximalist since 2018, and I just want to make the disclaimer that I'm not saying here that buying MSCR is a better investment than Bitcoin. Even if you manage to outperform Bitcoin, which could be the case, might be the case if you can buy with a low MNAV, and we can talk about MNAV and Bitcoin yield later on. But then you still need to ask yourself, what is the real risk-adjusted return? And normally, risk-adjusted return is coupled with a volatility, but that's not even the real risk-adjusted return, because the real risk-adjusted return is, you should account for the risk that strategy is that Coinbase get hacked and they lose all their Bitcoin, or
counterparty risk. That's like the key word. Yeah.
Or regulatory risk. And this is also what Saylor is saying. Like, he's not saying you should sell. He's saying never sell your Bitcoin. So he's also not saying you should sell your Bitcoin and to buy MSTR. And I think the opportunity, because I love that Bitcoiners are really critics, because they should, because we are rug pulled a lot through the years, a lot. So I love that they questioning where does the yield come from. I love that they're questioning, it's all fun, all those Bitcoin treasury companies, but I think you are better off just buying Bitcoin and self-custody it. So, and I think I agree with that, but I think the most opportunities are for the TradFi world, and they're paying, like, there are preferred trading out there with lower yield. So, I don't know, 5% yield, 6% yield. And the company still needs to make the earnings to pay the dividends. And strategy already got the assets, already got the capital to pay the dividends in the next 100 years, basically. They don't want to sell their Bitcoin, but they could. And other companies still need to make earnings to pay for the dividend. So I think that's higher risk with back to your previous question about what will people or investors or institutions attract to those new preferreds. I think if they figure this out, if they're figuring out that Bitcoin is this pristine collateral with low risk, basically, in the sense of it's non-counterparty or counterparty free money. Yes, strategy is storing it with a custodian, but I think if the markets find out, if they realize what Bitcoin is and how much risk it really is, and I think Bitcoiners have a notion of this, then and the yield is even better. Yeah, that it's gonna attract a lot of capital, I think.
Yeah. But then you are actually telling me that, as you said, these preferred are more for TradFi people to enter into Bitcoin and less like for established Bitcoiners who have been in Bitcoin, who have their decent stack and that now want to get some fiat denominated returns. Could it also work this way? Just if you are aware of all the trade-offs and you're like, okay, no, it's not with the same quality. It comes with counterparty risk. The risk is higher for sure, but I want to maybe dabble a little bit in traditional fiat world again because I want some steady interest or something, dividend. Is that a viable game to play, or would you say no, not at all?
So I do think it's more for TradFi than for real Bitcoiners, but also for Bitcoiners, the way I look at it is like, in your business, you have future liabilities, and you need working capital. You need enough funds to pay, to pay your tax, for example, in 3 months or next year. You need to pay the tax. So I think Stretch, and I think that's why Michael Saylor said it's basically their iPhone moment. I think Stretch is such a good instrument also for Bitcoiners who they know that they're gonna have liabilities, they need to pay it off within months or within a year, and Bitcoin volatility could mess things up. I don't know, you don't want to buy Bitcoin at $120,000 and need to sell it at $90,000 a few months later, and this could happen. And also Bitcoiners knows this, but if you are an entrepreneur and it's like a Stretch could be your savings account and get real high yield from it. One thing I love about it, and it's also because I have some anecdotes, but people around me, living around me, knows that I'm into Bitcoin and I'm helping people also sometimes, and so I lately helped somebody who already is retired and don't want to get the volatility of Bitcoin, but he's putting his money in those bank deposits, 3 months fixed or 6 month fixed, 2.4%. I explained to him, just buy Stretch and you still need to pay tax on your dividend income, but the yield is way higher than on your bank account. And the thing I like is that you're retrieving capital from this traditional markets and the central bank. You're getting money out of the euro and putting them basically through strategy into Bitcoin.
Through traditional products, yeah.
So, and I don't know who said it, but I think Dr. Jeff Ross said it like, don't feed the beast, don't feed the beast who is feeding off of you.
Yeah.
And I think that's a really net positive of those Bitcoin Treasury Companies or strategy in particular, because it helps people. It helps just capital going to Bitcoin. I think because if you think about it, there are some flows from Bitcoiners. If a Bitcoiner sells his Bitcoin to buy MSTR, it's like a fake flow because we don't have new capital entering the Bitcoin market. But if you have if the bond market is that these people with capital on their bank accounts or other institutions that normally would buy U.S. Treasury bonds, if they're buying these preferreds, there's really new money entering the Bitcoin market, and I think that's a net positive.
Yes, mind blowing. I mean, that's exactly what I was referring to, with my question, because Bitcoin and all these strategy with all the products it really is like the Trojan horse, that's funneling Bitcoin or like capital back into Bitcoin. And I mean, if I really am a Bitcoiner who probably thinks he does have enough Bitcoin and he can sell some of them, but he wants to have some fixed income, then why diversify into traditional fiat fixed income when you can diversify into Bitcoin-based fixed income? And that's probably where I think there's also an opportunity for some Bitcoin believers, who feel like, okay, as I said, I do have enough on-chain Bitcoin, even though we all know the saying, you can never have enough Bitcoin, but maybe with some, it's still like, okay, it doesn't make that much of a difference anymore, but I want to dabble in these other products. So there I see a connection. So very interesting. I have this one follow-up question, which maybe now some might be asking, and me as well. Like, we've talked about all these preferreds and convertibles and stuff. What about the common stock? Why would you still want to buy the common stock? Like, any advice there?
Yeah, sure. Because the common stock that's the levered play on Bitcoin. I mean, the common stock should outperform Bitcoin, because if it's not, then it's not working. And that's the intelligent leverage where Saylor talks about. Basically, ETF is like the same volatility as Bitcoin. Then you have everything below an ETF. Those are the preferred, so less volatile, but also less yield. Basically, above an ETF, you have also these other ETFs that trying to lever up. But MSTR is this 1.5, or it depends on the I think in my calculations, because I wrote a script that it's updated automatically. I think since August 2020, MSTR outperformed Bitcoin 1.5. So, and I think that's the bet. I think MSTR will or might outperform Bitcoin. But if you're buying MSTR, I think that's your investment thesis. And that's why lately there's a lot of talk about diluting the common stock, and the shareholders want Saylor to stop issuing more common stock. But I think this is a point that we need to talk about too, because people need to understand that to have successful preferreds, you need to have first a strong balance sheet. So this is where I wrote about the 3 phases of Bitcoin Treasury Companies. So phase 1, basically you want to get on debt. So you want to raise capital through debt to buy Bitcoin, because that's the most accretive thing. But nobody's going to buy your debt or your instruments if you don't have a strong operating business or a strong balance sheet. But you need to have, so phase 1 is issuing common stock to buy Bitcoin until you're big enough to have a really strong balance sheet. You have Bitcoin, you have also the volatility of Bitcoin, and then you could start issuing debt if your balance sheet is strong enough. So I think it's a necessary thing, and I think a lot of shareholders miss that part. And also, I think Saylor is, he's preparing for, if the money market funds are 7 trillion in size with a T, and they only issued 2.5 billion in stretch. I mean, what will happen if next Wednesday we have the FOMC? So the federal funds rate will possibly get lowered 25 basis points, maybe 50 basis points. But what if, I think, like the dot plots are saying that at the end of 2026 we're at 3.5%, but we might even be lower if the economy or the labor market is deteriorating faster than we think. I mean, the spread because the money market funds are getting basically that rate that the Fed is setting, term rate through bills or through other instruments. If that's gonna be 3.5% or 2.5%, and Michael Saylor is still offering 10% yield, I mean, I would take that. And to be able to take that, you don't want to have a too high of a leverage ratio. So you only should take on that much debt. So Saylor talked about 30%. They're now at 15% debt. and that's including the preferred. And he wants to raise that to 30 or maybe 50. So he said with non-cumulative preferred, you can go higher. With a preferred as strike or strive, you don't want to get too high, because if Bitcoin drops, then your leverage ratio, your debt is the same. So your leverage ratio is going up. So you need more. So you need also enough equity on the balance sheet in terms of Bitcoin to be able to have those strong preferreds and to get those high credit ratings in the future. So I think it's a necessary step. And that's, so I was talking about the phase. So phase 2 is getting take on debt to buy Bitcoin, and phase 3 will be make those accumulated Bitcoin productive. So the Bitcoin itself can pay down the dividends and not the issuance of anymore.
Yes, exactly. I mean, that these differentiating into these 3 different phases really helped me to understand, that we are, and you also called the Bitcoin Treasury Companies Bitcoin Arbitrage companies, in the sense of like there is this gold rush now with Bitcoin, and its first phase is try to get as many Bitcoin as possible. You probably do this through ATM, common stock issuance, and then at some point, if you strengthen your balance sheet, as you said, you can base off some of that debt, or like issuing some of the debt based on the strong balance sheet that you have, and it makes it sort of credible. And then you still have to maybe dilute your common stock here and there to pay off some of the interest that's coming due with the more fixed income and structured debt that you have out there. And then the third phase would probably be to make it productive. And I want to talk about this as well. But I want to come back to, because I'm still sort of struggling to understand where the connection between a Bitcoin treasury company stock and its Bitcoin holdings really are. Or why is it a given that if Bitcoin rises, the company shares will have to rise inevitably as well? Or is that like a fallacy? That's sort of where I'm still trying to understand this. This is probably also where MNAV comes in and everything. If we can take this apart, that would be great as well.
Yeah. So, I mean, that's a good question. And I don't think there's a rule, there's a law, there's just the market. I mean, there's people bidding on those shares because they know they're undervalued or overvalued. And I think because at some point, if your stock is worth less, so your total market cap is worth less than the value of all the Bitcoins on your balance sheet. And you can also look at like the enterprise value. So you do minus your debt. But at some point, your company is just undervalued. And maybe even there might come like a big bank or investors or a consortium of hedge funds. They say, all right, we believe in Bitcoin and this thing trades at 70 cents on the dollar. We could or buy Bitcoin at, I don't know, $100,000 each, or we could buy this whole company and get basically a discount on those Bitcoin and get, well, we're paying $70,000 for the Bitcoin. So I think that there will be like a floor that eventually investors gonna pick it up. And yeah, so, and why, and the big question is, why would it trade above MNAV? And I think that's the $1 million question. And I think it makes sense that if you have leverage on your balance sheet, that it should trade at some multiple. What it will be, I don't know. I think also MNAV is a bit of a sentiment gauge. If the market is booming, this ratio will go up. If the market is in a weak place, then this ratio goes down. And I think there will be opportunities for investors to buy the shares cheap. And I hope that not too much investors, but this is basically market cycle and this is human psychology. There are people who are going to buy Bitcoin or the shares at higher prices. And this is also where Bitcoin yield comes in, because let's say you buy shares at 2.0 MNAV. Basically, the market cap is double the value of the Bitcoin beneath or on the balance sheet. Then, if a company managed to grow their Bitcoin per share with 10% a year, then you still need 9 point, I don't know, years to get to 1 MNF for you as an investor. So it takes time, but that's also from a Bitcoiner's perspective that they want the Bitcoin, and the Bitcoin isn't yours. So, I mean, maybe you shouldn't look at MNF. So I wrote also in my articles about the arbitrage window. And I think this makes a lot of sense. And I think this is how people, or how I look at it. So there's this opportunity, and there's a window of opportunity. And if you look at our trends, you have this CAGR, this compounded annual growth rate, and Bitcoin now is growing with 40% a year, according to Fred Krueger and Matthew Mazinski's models, 40%. In 2035, it will be 25%. But let's say those models are wrong, and we'll be this year on 25%, and in 2035 we're already at 10% CAGR. So that's Bitcoin isn't gaining in value as much as we hope. Yeah. Then in 10 years, it's not possible to issue preferred stock at 10% yield when you only get 10% increase in value, because then this arbitrage opportunity is closed. Like, this window is closed. And that's also why I think I hear a lot of criticism about, I didn't hear one mention about from the companies how they're gonna make their Bitcoin productive. And I think it's a valid argument, but my question is, should you be questioning as an investor that question right now? Or should you want to have the management team focus to extract the maximum potential out of the arbitrage window, the arbitrage opportunity? And I think I heard Saylor talking about, someone asked him, did you, what did he ask? It was about bad decisions, and he didn't regret bad decisions because he didn't engage, or he didn't engage in bad decisions, but he was reading that he was getting after good ideas, but those were allusive to the great ideas. Basically, you only should focus on great ideas. And this is where his focus, his laser focus comes from. And that's, I think, why they're only talking about how to accumulate as much Bitcoin as they can during this window of opportunity.
Yes, makes sense to me as well. I want to talk about monetizing Bitcoin as well, in this third phase that will inevitably come, in my mind, in some point in the future. And we, as you carved it out as well, we don't really know when this is the case. It's probably some bubbly window. It's not from day one. Now we're in phase 3, but it's sort of, it's going from one into another, and we will slightly see it. But again, what is the future that you picture for MSTR in the sense of, as a holder, will it always be sort of a growth stock, that never pays out any dividends? Or could it also pay dividends at some point? Or if I am holding MSTR, and I know, like, theoretically speaking, I have a way to own the underlying Bitcoin as well, because through the law that we have, securities law, this is established. But what am I getting in the future, maybe? Have you thought about this as well?
Yes. So I think people should realize, let's say, and this is also what is your own expectation of Bitcoin? Because if you think Bitcoin is going to 1 million or 2 million or like above and beyond, then basically you're buying in this theory of that Bitcoin will increase in value over the 10 years. So people should think about this. If they now can raise capital at $100,000, and pay 10% yield, or they need to pay 10% yield on it, $10. In 10 years, Bitcoin will trade, according to this trend, between 1 million and 1.5 million. Yeah. So this investment that you made, like $100,000 now, will be worth in 10 years 1.5 million. So this yield that you need to receive in 10 years on that investment is less than 1%. You need less than 1% yield to pay the dividends that you're liable for. And that's why I'm really thinking in this arbitrage window, in this winner's opportunity, because I'm okay with as an investor that they keep issuing some common stock to pay for the dividend until the time comes that you can have on a secure way, like low risk, that you can get 1 or 2% yield on that investment on those Bitcoin, and they can pay they pay 1% on those preferred liabilities, and they still have some profit. And what could that be? Like I think there are companies showing that now in Lightning channels you can get 1 or 2% yield on routing payments. But I mean, I think the Lightning channel has 4,000 Bitcoin in it, so there that needs to increase 100-fold to be able to so for strategy to be able to put really a lot of accumulated Bitcoin to work. Yeah, I don't know. So he also talked about trying to invent a fighter jet, yeah, as an engineer. But you could try to invent a fighter jet, but if the jet engine isn't invented yet, you don't gonna make a fighter jet. I think we're also in this phase that we don't know what the future will bring in 10 years. But I heard Paolo Arduino from Tether talk about AI agents communicating with each other, and he's talking not millions of AI agents, but billions of AI agents. And if they pay each other, because you have AI agents autonomously use other AI agents, and if they just pay for electricity cost, and if you let them pay with Bitcoin or on Bitcoin rails, then there will be a need for a lot of liquidity. So maybe those opportunities will come in the future. So that's the question. So should you focus now very much on how that will play out, or do you focus, all right, this is the opportunity right now, we can see it, we can make the most of it, and we try to accumulate as much Bitcoin as we can, and then in the future we'll see what we'll do with the Bitcoin. But I agree with the criticism, and I agree that strategy, I think, at one point should convert into like a bank, or like with a business with a bigger operational business than they now have.
Yeah. I mean, as you said, as I think about it, Bitcoin strategies, because they have such a strong balance sheet, 600,000 plus Bitcoin on their balance sheet, I think they are in the best position, and they have maybe more strength to wait it out, and to really see how Bitcoin is developing on the Caker side as well. When it comes to other companies, maybe, who have not had this head start because they didn't figure it out and are only now just starting, I think, to me, they will probably be urged and compelled, to look at this earlier, maybe already work with their Bitcoin productively. And I can say from experience working at the bank now that this is exactly what we're hearing from Bitcoin treasury companies who are interested in looking for yield opportunities, or also some hedge funds, who provide these yield opportunities, that they are in talks with these treasury companies. So, and we've seen it with Adam Back, who launched this Bitcoin treasury Bitcoin Standard Treasury Company, and they explicitly had this in their filings, that they want to be a productive company, having Blockstream on the side, with all the funds that they have, Alpha Yield Income Fund. So they have the opportunities. But I think, this will be something that will just grow from now on, and we're probably gradually moving into this phase 3 already with some of the companies. But these phases that you sketched out here helps a lot to understand this. And you have anything to add?
Real short on Adam Beck. I think Blockstream is a real good example of, they're keep on developing all these services, and they might be able to use those Bitcoin on the balance sheets in favor of those services. I think you can use a service from them to run a Lightning node with them providing liquidity. I think those are the examples that those are the right examples of getting some yield on your assets. Yeah.
Yes, exactly. I also heard you talk about strategic fiat reserve. Maybe a term that doesn't bode that well with that many Bitcoiners, but can you elaborate on this, what you meant and why it's maybe important to have something like this? Probably in the context of Bitcoin treasury companies, I guess.
Yeah, for sure. So this was a bit of a joke from me. You could call it strategic field reserve. The thing is, people are thinking about what will happen in a bear market and how should a Bitcoin treasury company should prepare for a possible bear market. And that's why when I thought about a strategic field reserve, but you also could call it a strategic liability reserve. And the thing that I want to point out is if you're living on a fiat standard, you need a strategic Bitcoin reserve to bail you out in the future, maybe, It's your insurance, it's your credit default swap, it's all those examples you heard over and over again. But if you're on a Bitcoin standard, those dollar liabilities may bite you in the in
In Yeah.
and they could, because we didn't talk about this, but strategy doesn't really has a liquidation price anymore. But what they do have is they might get forced. Well, I talked about Strive. They might get forced to sell some Bitcoin if they miss payments, dividend payments. So you don't want to miss dividend payments. So what I would do, and basically strategy is already doing this in some way, but they said, so we're going to use MSTR to pay for the dividends. So I'm thinking in this concept of you have a debt machine, and the debt machine is to accumulate Bitcoin, and the common stock machine, the equity machine, is to accumulate cash. Cash to pay liabilities for the dividends on the debt, or to service the liabilities. But so think about it. I think strategy now has $600 million dollar liabilities per year on the dividends on the preferreds. Yeah, 600 million. So if you would say Bitcoin could trade in a bear market for 2 years historically, then you could build this strategic liability reserve, and it's 1.2 billion or 1.4 billion at current issuance of the preferreds. And then you show the market a couple of things. You show the market on the preferreds, we're going to pay the dividend. We're going to do that. We're securing the next 2 years of dividend payments. So the preferreds will trade up, I think, because there's less risk. And if the preferreds are trading up, then you have more traction. So you can issue more and buy more Bitcoin, but also
which is good in the bear market, right? Then he doesn't buy the top anymore, and also sometimes maybe where it's actually nice to buy it.
Yes. So that's a good point. And also, I shared the example earlier that if your preferred is trading at a higher value, if you want to raise some capital, your dilution is less. So your future liabilities are also less. So I think that's a good sign to the market. Another sign will be strategy will not be the trigger of a new bear market, because we don't have a liquidation price and we are able to pay the dividends. And so we're not going to sell our Bitcoin. It's basically because now they have this guidance that if MNAV trades below 1, we could issue credit and then buy back stock. I think you should be prepared. I think you shouldn't trade below 1 MNAV if you're prepared correctly or not too long. And if you have this cash cushion, then you can buy back your shares. So what I would do, I was thinking about it, and I would propose. So when there's exuberance in your stock valuation, so your MNAV is trading above 2.5 or 3, or I don't know, depending also on which company, then you should raise cash through issuing a common stock, put that in this strategic reserve, show the market that you can pay the liabilities for the coming 2 years, and maybe even, and that's where you were alluding to also, that you might get opportunities along the way during the bear market to acquire other companies when they weren't prepared as good. And you can, if they trade at 0.6 MNAV, maybe you can just do an acquisition and just acquire the company with those Bitcoin.
Yes, because that's my believe. I haven't looked into all these companies. I mean, there's tons nowadays, but just from experience and maybe from logic, I would say it seems inevitable that one or two companies will fail down the road because they don't manage everything, as you now explained, that neatly. Might be an opportunity for investors to maybe short, then like BTC Treasury coming up in a bear market could be a nice shorting opportunity. And then for other who have done the homework, like other Bitcoin Treasury companies, to come in and buy them out, so to say, and get the Bitcoin. The way you explained this, you see strategy and maybe also other Bitcoin Treasury companies preparing and setting themselves up for this? Or is this just you speculating and trying to help with ideas? Or from what you can hear, is anyone doing something along these lines, to be prepared?
Not yet. So this is me thinking about how I think I would go to it. And I think, this is just, I think, because I mentioned 1.4 billion for the next 2 years at the current issue preferred stock. I think it's not a sin as a Bitcoiner, as a Bitcoin maximalist, to have 1.4 billion on 70 billion. That's basically, 2% of their assets in cash, 98% in Bitcoin. I mean, that's okay. That's okay. And I think it's not a sin. And I think it might be, it might be a strategic opportunity to get on top, because, it's a marathon, it's not a sprint, and you should be able to get through the next bear market. And to your question, I didn't see, because I think the most companies are still focusing on accumulating Bitcoin, and that's a good thing. But yeah, I've been through multiple cycles, and I know the feeling of a bear market, and it hurts in your gut. Even though you have conviction, even though you think it will be all right in the end, but it hurts. And I think I think I should prepare for that some.
Yeah. That's sort of my belief as well, because a bear market won't announce itself in the sense of like, okay, now it's bear market, go guys, let's try to raise some cash for the winter. I mean, that's probably how the market works, it goes against most people's beliefs. And that's where I feel somewhat cautious, believing that some of the Bitcoin Treasury companies, as you said, they're still in the belief that, okay, we're in this super cycle, because Treasury companies are here, Bitcoin will go up more. And I feel maybe some will be caught off guard. And then this could end somewhat badly for those. But I guess for the bigger ones as Strategy and maybe Metaplanet and what else, I mean, they are probably thinking about this, because I've heard them here and there make these arguments. And you're perfectly right. That's exactly, I mean, that's probably where the signal is at, even if you are on a Bitcoin standard, never put all your eggs into one basket. 2% is just fine, and should even be fine with the most adamant Bitcoin maxi, I would argue. Any last statements that you want to share?
No, I think we went through the most important topics. And the last thing I would add on that strategic liability reserve is that I analyzed what the last 3 weeks they already raised 900 million through common stock, and they bought Bitcoin with most of it, not all of it. So I think they're already preparing. But they're preparing for the next dividend payment for this quarter and not for next year. So, but 900 billion, that's almost that. They're already close to having. They could have had this cash cushion. So last thing I want to add on that, because what they're doing is basically they're doing a DCA, like a quarterly or a monthly or weekly DCA. They're raising cash with issuing common stock. So, and sometimes a DCA could be better than a poorly timed lump sum, but a good timed lump sum beats a DCA. So, and that's why I say they should raise cash when there's exuberance in their MNAV, because that's the lump sum and that will beat DCA. Because otherwise, you need to raise capital, you need to issue common stock at an MNAV at 1.4. And then you're diluting the shares way faster than issuing common stock at MNAV of 2.5 or 3. It's better for shareholder value. So yeah.
Yes. Yeah. No, that was a great add-on for sure. Well, Johan, thanks a lot for doing this. Maybe you can tell all the people where they can follow you and read more about your insights.
Yeah, so very thank you that I was welcome on your podcast. I really enjoyed the conversation, and people can find me on X at Johan M. Bergman. I'm also writing for the Bitcoin Layer, so please check it out, the Bitcoin Layer from Nick Batia firm. And yeah, you can also find me at The First Bastion. That's basically the Substack I wrote for my own audience. Yeah.
That's good to know. Yes, we try to link to everything in the show notes. Yeah, Johan, thanks again for coming on. I really enjoyed the discussion. We'll have to do this in the future again. And until then, enjoy the rest of your day.
Yeah, you too. Thank you, Pascal.
Thank you.
Bye-bye.
Bye.